Hey, Rick Soukoulis here. Time for a little mortgage math again. I want to talk a little bit about Credit Suisse and independent mortgage bankers. You might think the two don't go well together, but look, owning yesterday's interest rates can be no bueno. Just kind of like the surgery on my arm, still playing with my chicken stick. The arm is not yet bueno. So anyway, had to throw that in. So I want to talk about what the deal with Credit Suisse was all about and why it's important to us over here in the United States, and really what's going to happen or what effect could happen to mortgage banks. So let's look at the deal first of all, because it's super interesting, right? Here you've got a bank that had a tangible book value of $45 billion. $45 billion. And it had what are called COCO bonds, which are contingent convertible bonds. That are debt, basically, they're bonds, but they convert into equity with certain triggers. Another $17 billion. So you got a bank worth $62 billion in these two pieces. And what ends up happening is they get in trouble. There's a run on the bank. They got sold for $3.2 billion. It's a pretty small number. It's like 5% of the tangible book value in the COCO bonds. It's like, what? Okay, so you look a little bit deeper, and the Swiss government tells the buyer that, look, buyer, you take the first $5 billion in losses that may come. So they're over here. 3.2 in purchase price, $5 billion in first loss. Basically, your purchase price, worst case scenario, is 8.6. And if there are losses, we'll take 10 billion of them after you take the 5, of course. So here you are, you've got 8.6 buys you basically $72 billion in value. Do you think there might have been some calculation in the tangible book or something we didn't see? I don't know. But here's why they're important. They're globally important because they're derivatives traders over there. The Swiss bank, Credit Suisse, is very involved in derivatives trading globally. Now, what are derivatives? Well, there's things like options, futures, swaps, equities. So they trade all of these the movement between all of these different instruments. So in mortgage banking, we use TBAs, to be announced mortgage-backed securities, to hedge our pipelines. And some who are really on the ball will use T-bill futures to take the shock out. So these instruments are used by banks and different institutions to hedge their risk. So if you have Credit Suisse blow up, it is really no bueno. And it's not, but I just thought it was really interesting to see that value versus tangible book value. Kind of the same thing we saw at Silicon Valley Bank. And because if you're looking at the tangible book value to try to figure out the value of a bank or what their tier 1 capital is, and you can't trust it, it could get a little bit hairy. So that said, do your own research there, take a look. We're going to see more of this going on in banks, but I really want to talk about why I don't think it's going to affect us too much. And the fact of the matter is 75% of mortgages today are done by independent mortgage banks. Over 90, I think it's like 95% of FHA loans are done by independent mortgage banks. So what is an independent mortgage bank and why are they different than banks? And I was watching a video put out by Kevin Perino this morning. It was great. He goes, nobody bails out independent mortgage banks. There's nobody who steps in and says, I'm going to throw a whole bunch of money at you, independent mortgage bank, because that's just not where we live in the food chain. So let's look at where we are. Independent mortgage banks will always act before they're asked, and I'll tell you why, having operated several of these things. Our oversight is basically coming by the GSEs and our warehouse lenders. You've got the regulators and all that. But look, there's reporting that has to be done if you're a Fannie Mae seller servicer. You got financial statements that go out annually. They're audited. You got quarterly statements. And those statements have covenants in them. Things if you miss, you've got problems. And Fannie Mae, of course, Freddie Mac, they'll work things out and they'll help you get, moving if you have a liquidity issue and the shareholders bring in more cash. They're fine with that. But you got a lot of folks losing money right now that are going to be, worried about covenants. So what happens is the GSEs provide that oversight. There's also the lines of credits, the warehouse lenders that are providing that. Now, mortgage bankers, they don't keep mortgages long. Most of them are out of that position in 30 to 45 days. They're hedging every single day. Up first thing in the morning, watching the markets going, making sure they're covering their pipeline. Can they get caught off sides and have problems? Sure. Did they get caught off sides in '08 and have some huge problems? Of course. So yes, there can be. But in this particular cycle and what's happening with the banks, it's a mismatch between the long and the short. The guys at Silicon Valley Bank had a whole bunch of mortgage-backed securities at a very low interest rate. That's no bueno. You go to sell, something that's carrying 0.5%, 2.5% interest rate in a 4.5% or 5% market, your discount could be up to 20%. So something that you put, $1 billion in, it's now worth 800. Mortgage banks really don't have that problem. The next thing that they do is they keep a small piece of every payment flow. It's the servicing strip. So when they sell that loan, they're creating a residual income stream. And they're watched very closely. So what's in that reporting? There's looking at the balance sheet, the income statement, schedules of loans, servicing right, operating metrics, but most important is the liquidity report. So by the sheer nature of how mortgage banks operate, we're managed by what I think is one of the greatest risk managers out there, Fannie Mae and Freddie Mac. I mean, these guys know risk, and they are all over the independent mortgage bankers' financial statements, and they know how to work through problems and situations 90% of the time. So disruption in the mortgage space, not from independent mortgage bankers, hitting some explosion event like we had in '08. Some people will get sold and traded, and things will happen, as interest rates continue to rise, more from an operating basis than some kind of a risk basis. Anyway, I thought that'd be an interesting topic. I was certainly interested in this deal over here and just wanted to kind of bring those things together because there's a lot of headlines right now about what's happening with banks, in the United States as well as globally. Hey, I hope this helps you. Thanks.